Hi, this is Stuart Weems, and thanks for listening into the Investopoly podcast. My goal is to give you simple, easy to understand insights, strategies and tips to help you master the game of building wealth in 5 minutes or less. In this episode, what I'd like to talk about is investment grade property. You know, when people talk about investing in property, they talk about property as if it's a homogeneous asset, as if all properties are created equal and you can just invest in anything and you'll make money. Well, obviously that's complete garbage. And I think it's really important when talking about property, we need to define what sort of property we're talking about. Now, throughout my podcasts and blogs and these sorts of things, I'm talking only about investment grade property. What's the definition of investment grade property? Well, simply, it has the fundamentals to provide an investment grade level of capital growth. And so that means it should double in value every 7 to 12 years. Now, I know that's a big range, but obviously depending on the type of property and its value and location and so forth, different investment grade properties are going to be low investment grade or high investment grade, and as such provide different returns. But really, if you're investing in an asset that doubles in value every 7 to 12 years, you're really getting capital growth of around 7 or 8%. To up to sort of 12 or 13%. Again, big range, but that's what we're aiming for. So any property that's going to do that perpetually, and when I say perpetually, really for the next 20 or 30 years, can't really predict beyond that, that's what I'm talking about, investment grade property. So investment grade property has 3 attributes. The first one is more than 50% of its overall value needs to be land. A property's total value is the aggregate of the building value plus the land value component. Typically, you can split it into those sort of 2 components. So you want more than 50% in land value. The easiest way to work that out is to speak to local real estate agents. They'll tell you a per square metre land value. And depending on if it's a house, that's easy. If it's an apartment, you can just sort of notionally divide that land area by the amount of apartments that sit on the block. Or you can look at a rates notice and you can compare the proportion of unimproved value versus capital or improved value on the rates notice, and they'll give you an indication of what sort of percentage you're dealing with. The second attribute is you want proven performance. That is, you want to go back and have a look at past sales over the past 10, 20 or 30, 40 years and imply a capital growth rate. You want to see that it's sold for $90,000 in 1985, and today it's selling for $1.3 million, and bang, there it's probably about 11 or 12% capital growth. The thing about past performance, obviously it doesn't guarantee future performance, but the things that drive property tend to be static, so they rarely change, and they're factual. You know, they're a question of fact. Things like amenities like hospitals and schools and shopping districts and so forth. These things take many, many years to change, if at all. But they're the things that have probably driven growth in the last 20 years and will probably drive growth in the next 20 years. So you want to invest in an asset that's proven its ability to generate strong capital growth. And the last one, number 3, is scarcity. You want an asset that is scarce. Scarce in terms of land supply, so you don't want any land supply in the area that you're investing in. In fact, there should be almost nil land supply, and that is access to vacant blocks of land. And then also scarcity in terms of architectural style. So things like Art Deco units that were built in the 1920s, 1930s, no one's building that style anymore. They're double brick and they're built very well. Or Victorian cottages, 2-bedroom cottages and so forth. Well, no one's building that sort of architectural style anymore as well. So, in fact, their supply is really reducing as properties get bulldozed and they're dilapidated and so forth. So that's what sort of creates that scarcity element. And they're the 3 attributes of investment grade property. So more than 50% of its land value is number 1. Number 2 is proven performance. You want to track back sales and only invest in assets that have already proven their growth. And number 3, you want scarcity. Scarcity in terms of land supply, architectural style and so forth. I hope that helps. Bye for now.